Okay, in part 2 here we're going to continue on our path to talk about choosing assets, and in particular in this case choosing stocks for a portfolio. So we're going to work our way up to essentially what's referred to as the capital asset pricing model. So the next step we want to talk about is adding another asset. Prior to now, we've been talking about stock portfolios, a combination of assets that are only stocks. That is, they are all assets that have risk. Now what we want to do is add the opportunity to invest in the risk-free asset. So now we have two different components, if you will. We have an asset that has a return but zero risk, and then we have combinations of assets that have returns but also have some form of risk. So what we want to do is try to figure out, well, how do you know what kind of a asset you would like to buy? So if we took an arbitrary kind of a investment, a risky portfolio, we could calculate its expected return. So the expected return on a risky portfolio, right? Here's the expected return, and X is how much money is invested in that particular portfolio. 1 minus X is how much we would invest in the risk-free asset. So this is just the weighted average return for a portfolio with a risky portfolio and the risk-free asset as components. And of course we can solve for that. You can do a little algebra here. So it's the risk-free rate plus the weight, how much money is invested, or what's the proportion invested in the risky asset, times the difference between those two. Hopefully this formula starts to look a little familiar to the security market line formula from a previous chapters. So here we have this particular portfolio. Here's the portfolio we're thinking about buying. Portfolio P. Here's the risk-free asset. And again, if you remember from our previous discussions, the straight line relationship everywhere between risk-free and P, these are positive long investments between those two investments. Once you go beyond P, though, we are now borrowing at the risk-free rate and taking that borrowed dollars and purchasing more of asset P. So everything along here is the risk-return relationship between the risk-free rate, the risk-free asset, and a portfolio that we've chosen, which is P. So the question ultimately is going to come about, say, well, wait a minute, where is the efficient frontier for these new choices? So let's move on. If you're buying stocks on margin, again, we're borrowing money to invest in a stock, right? A portfolio that has a short position in the risk-free asset is going to be referred to as a levered portfolio. The margin investing in a risky investment strategy, if you will, right? So you want to be the investment part, right? The negative investment is the risk-free part, and the margin is the piece. It's the equity or the amount that you own in the risky asset. And so in other words, the margin is X, and the portfolio piece is 1 minus X. So to find out the highest possible return, we need to have a way to associate the risk-return relationship in this two-asset portfolio to the efficient frontier that's available from investing in all different assets. And that sounds a little confusing, so let's just take a step forward and see if we can get to the math and ultimately an illustration so we can make this point. there is a formula for something called the Sharpe ratio, and that is the portfolio's excess return in the portfolio minus the risk-free rate, divided by the standard deviation of the portfolio. And the portfolio with the highest Sharpe ratio is where we would like to invest. You want to maximize this risk-adjusted reward to volatility ratio. You want to get the most that you possibly can. But our choices of investments are, you have, go down one, you can invest in the risk-free asset, or you can also invest in risk-free plus any combination or any asset that's in this universe of possibilities. Well, here's P, and what you can find from P is, that these assets are not efficient, right? If you draw a line from 5% here, and I use the example, maybe you have like a ruler, and you take this ruler and you move it down, 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 till you get to where it just touches 1 point. This is the portfolio that you want to think about investing in. And as you can see then, if these are our choices, again, between 5% and here, these are long positions. You're going to buy Treasury securities, and you're going to buy this efficient portfolio up here. And everything beyond that point is you're going to borrow at the risk-free rate, and you're going to use that money along with your investment money and buy more of this efficient portfolio. So everything below this line now, everything below this green line is now inefficient. So what we ultimately have identified here, then it says, look, if this is your universe of choices, the risk-free asset can be combined with any portfolio that you can think of out of the entire universe of risky things. However, there is only one portfolio, this one tangent portfolio right here. That's the only portfolio that is on this line that connects the risky assets and the risk-free asset. This portfolio, by the way, is a portfolio that maximizes the Sharpe ratio using the risk-free asset as that risk-free variable. So the tangent portfolio is the only risky portfolio that anyone would want to buy. So what are our choices then? It's going to depend on the person, right? Conservative investors are going to want just a small amount of risk. Aggressive are going to want more. However, they all want to be on the efficient portfolio. They want an efficient investment. So that's essentially what we're talking about here when we used this theory a little bit earlier, something called the separation theorem. What it says is that in theory, everybody wants the same investment. Everybody wants that portfolio, the tangent portfolio. Nobody's going to want any other risky asset. Everybody wants that one. But then not everybody, though, is going to have the same portfolio. You're going to choose based on your risk level. Conservative investors are going to want to be down here more because they want to invest in risk-free and risky. But more aggressive investors will be up here because they're willing to borrow to get even higher rates of return than what the portfolio itself would give them. So the separation theorem says what you buy and how you finance are two different questions. They are separate. They're distinct things. So in the end, we end up with a formula. Our formula says if you want to find the expected return on a portfolio, it's the risk-free rate plus the beta of the efficient portfolio multiplied by the risk premium. And again, a portfolio is efficient if and only if the expected return for every other security equals its required return. They all have to be equal. If that's true, then we now are talking about this efficient portfolio concept. The theory that we're talking about here that we've just developed is something called the capital asset pricing model. It allows us to use the optimal choices that people make to help to identify efficient portfolios. In fact, the efficient portfolio we're going to talk about is the market portfolio. It's the portfolio of all stocks and all securities, all possible investments in the marketplace. So before we even go any further, I think we need to mention that hopefully you know you can't measure that. We can't measure this market portfolio because all the assets in the world cannot, at any one point in time, you can't calculate what the value of everything available in the world is. So we do have some challenges with the capital asset pricing model. In fact, it has some assumptions. The first assumption is that investors can buy and sell securities at competitive prices and they can borrow and lend at the risk-free rate. So we have a marketplace that is competitive, that prices are available. You can get them whenever you want them. There are no transaction costs or taxes, right? And in addition, you can borrow and lend at the risk-free rate. Assumption 2, investors hold only efficient portfolios, right? Those, again, are portfolios that maximize the return for given levels of volatility. We have to assume that investors are going to seek out to be at that high end of the curve so that that's where they're going to ultimately invest. Everybody's going to be up there. And finally, investors have homogeneous expectations. In other words, investors have the same estimates about future investments and their returns. Everybody sees the same volatility, the same correlation, and the same expectations of returns. So if, given this idea of homogeneous expectations, all investors are going to want the same portfolio. They're going to see the same set, so they're all going to pick that market portfolio. The combined portfolio then is obviously going to be that point, that one point of securities at the very top on the efficient frontier. So if all investors demand the portfolio and the supply of securities is the market portfolio, then obviously it's this market portfolio has to equal the supply of the market portfolio. In other words, if that's what people want, that's what people are going to have as supply. The market's going to supply what the people want, and people want that market portfolio. So when the capital asset pricing model holds, then what we create is this line, which is referred to as the capital market line. So let's look at what that line looks like. That's the one we've just created a little while ago. Here's the risk-free rate. Here's this market portfolio. And this green line is the efficient frontier. Well, in this case, since we're talking about assets and the combination of a risky asset and a risk-free asset, it's also referred to as the capital market line. Where are people going to choose to be? It depends upon them. They're going to be somewhere on this line is where they're going to pick their investment opportunities. But nobody's going to have individual stocks. Nobody's going to have any portfolio of these individual stocks. It's all going to be a combination of just two things. This risk-free asset, either investing long or short, and then they're going to buy this market portfolio. To get this to a more workable product, something that you and I can use on the investment side, we ultimately get down to the idea or the concept of what we've talked about in other classes, which is something called the security market line. According to the capital asset price model, if the expected return and betas are plotted, they should fall on this particular line. Well, how do we get this line? Well, here's the capital asset market, or the capital market line calculation we have so far. And if you go straight across here, here's the risk-free rate. Well, that's great. Here's the stock market. The stock market has a 10% return. So if you go over here, here's 10%. If you dot a line across there, there is a point where these two things cross. Down here, for risk, we're talking now about beta. So wherever beta is, wherever beta is, that's where the market portfolio is going to be located, because that's where that's where the capital asset market line says the market portfolio is. Now what you can notice is, look, these stocks are here. They're inefficient. They're not on the line here, right? They're not up above here. But this measures risk using standard deviation. Once we switch to the security market line concept, all the stocks are going to line up on this line. The capital asset capital asset pricing model says that the security line will identify the rates of returns of all assets, and they are a linear relationship between stocks and bonds. So how can we ultimately think about using this? Again, here is this equation one more time. Everything is on this line. Well, let's say, though, that we calculate the expected return on McDonald's, and it turns to be up here somewhere, right? It's above the line. Well, the theory says it should be on the line. So any stock that we analyze, or any asset that we look at, that doesn't fall on this line, we're going to assume, the theory at least assumes, that that asset is mispriced. So if it's up here, it's giving more than what people think it should get. People want to buy things that are up here. Since they want to buy them, demand for those things is going to grow. As the price increases, the stock price is ultimately going to fall, so that in equilibrium, it shows up on this line. Likewise, down here, the stocks are overpriced. People recognize that, and they start selling off the stock, taking the profits that they think they see. If everybody is doing this, then that is going to drive the stock price down, which ultimately increases its return till, again, in equilibrium, it shows up on that line. So how we apply this to a portfolio, we need to know what is the beta of the individual assets, and the portfolio the beta of the portfolio is the weighted average of the weights multiplied by the individual betas. So we have a worksheet called Portfolio Beta and Return, and we can do a couple things with that. Let's say we're going to put 50% of our money into Kraft, and we're going to put the beta of Kraft is 0.5, and Boeing's beta is 1.25. The risk-free rate's 4%, and 10% is the rate of return on the stock market. So we want to know, if you have equally weighted portfolios, what should the return on the stock be? So what we can do here is we can calculate. Here's 50%, 50%, right? So what should the return for each stock be? Well, here's 4% the risk-free rate. The stock market returns 10%. So for Kraft, you would expect to get 7%. So we plug 7% down here. For Boeing, when you plug in 1.25%, since it's riskier than Kraft, you would expect more, and that's 11.5%. So if you bought this portfolio, 50-50 of each, you would expect to get 9.25%. If you plug in the betas in this beta and return calculation, again, we'll end up with a portfolio that has a beta of 0.875. Now, if you plug the 0.875 in the same CAPM security market line component on that worksheet, you'll find that it predicts that this stock should earn a return of 9.25%, which again you can see is exactly equal to what we calculated up above. So it seems theoretically that if you know the betas, if you know the returns on the stocks, then ultimately we can calculate the expected returns from portfolios and from individual securities. We can transfer this forward then into talking about projects. How do you calculate the required return on a project? That's for a further chapter. So in general, the market portfolio is an efficient portfolio. The risk premium for any security is proportional to its beta with the market. So we want to understand that the riskiness of an individual security has two parts. It has the market premium, what you get for buying in the market, but every asset then is also weighted by its individual riskiness as measured by beta. So that's the end of Chapter 11.